Our industry expert, Mr. Hariharan, is with us today. Sir, what are the risks in debt mutual funds?
First risk is a credit risk. The credit risk is very simple. We said debt is nothing but a borrowing. So there is somebody who is lending the money, somebody who is borrowing the money. And the first question in the mind of people is, if I've lent the money, will he give back the money? That's called credit risk or the risk of default, right? And again, the risk of default is not uniform. In the case of government securities, public sector corporate bonds issued by PSU companies and instruments issued by banks, it is assumed that they are absolutely zero in terms of credit risk, right? Similarly, state government bonds are backed by the central government, so they are also considered to have zero credit risk. The other risk is what is called as an interest rate risk, and both these risks are very important from a debt mutual fund perspective: credit risk and interest rate risk. Interest rate risk, as the name suggests, is if the RBI were to change the interest rates, which means they can either increase or reduce, there is an impact on the price of existing debt securities. Okay, I repeat, if RBI changes interest rates, there is a impact of the change in interest rate on the price of the securities that I'm already holding. And this impact is in reverse direction, which means if RBI increases the interest rates, the price of my existing debt securities will fall. And when I say fall, means capital loss. Okay. On the contrary, if RBI cuts interest rates, the price of my debt securities, which I'm already holding, will go up, which means I will generate capital gain. So this is another important point. In a fixed deposit, traditional instrument, there's no possibility of capital gain. You get only interest. But in a debt mutual fund, some categories of debt mutual fund can give you both interest income as well as capital appreciation. But please remember, there could also be capital fall. Okay. But these are two important risks in debt mutual fund: credit risk, interest rate risk. The fund manager will try to create a portfolio which will try to minimize both these risks. Or if that particular mutual fund has those risks which is higher, for example, a credit risk fund, which I showed, clearly it says that there is a credit risk in the fund. So therefore, somebody who is willing to take that risk will come. Not everybody can come, right? Similarly, interest rate risk will impact longer securities more as compared to shorter securities. All right. So if I have a portfolio in which the fund manager has taken long securities, then I should be more worried about what RBI is going to do. If I have a shorter duration security or the maturity security, I don't have to be worried because the impact is going to be very less. So again, the fund manager, depending on so there are mandates from SEBI as well, which fund you can have credit risk, which fund you can have interest rate risk. Not everything will have all the risk. Okay. Some will have more, some will have less. Just like equity, not all equity funds have the same risk, right? So these are two important risks. There are a couple of other risks. One is a reinvestment risk. The other is liquidity risk. Now, again, reinvestment, this is again more theoretical in nature, may not apply practically to debt mutual funds, barring very specific situations that come up. But reinvestment risk is what typically fixed deposit investors face. And I will take you back to 2011, 12, 13. If I recollect, FD rates at that point in time was 9.5%. After that, we saw interest rates getting down. FD rates started coming down. And as I showed in 2020, FD was 5.4%. So an investor who is always investing in fixed deposit, if he does a 5-year FD and he's getting 8% today, let's hypothetically assume, after 5 years, the amount gets matured. He's going to again deploy the money in fixed deposit. At that point in time, what is the FD going to offer? Is it going to offer 8% again? I don't know. If it offers 7%, that investor faces what is called as a reinvestment risk. I'm reinvesting my capital. Do I get the same interest rate as before? Then there's a liquidity risk, which is very simple. If I want to exit that investment, am I able to do it without too much of an impact cost? Again, in a FD, if you try to exit, or even with SCSS, POMIs, all those small saving schemes, if you try to exit before the maturity, there are penalties. Okay, so which means you come out of the investment, but you pay some penal charges, right? So basically, these are the type of risks that exist. Important to consider all of them before you invest in a mutual fund.
Thanks for your detailed explanation. Are you in search of a personal guide who can remove the stress of handling your finances? Then please feel free to avail our expert consultation. And also you can attend our webinars to gain investment related insights. Both the consultation and webinar are absolutely free and you can find the link in the below description. Please like and share and do subscribe to Holistic Investment.